US tariffs are decimating the Canadian economy. Are they going to dump US Treasuries again? Canada, beneath the serene surface of maple syrup and politeness, lies an economy in flux, grappling with soaring deficits, rising unemployment, and affordability nightmares. The economy is shrinking, the trade deficit is soaring, with a recent record current account deficit as tariffs bite and unemployment reaches multi-year highs. Welcome to the deep dive on the Canadian economy. So here is a very familiar chart. This is the unemployment rate relative to the inverted budget as a share of GDP. Canada, very similar to the US, started to run ever larger budget deficits over the past 25 years, despite an unemployment rate that is flat to arguably even down slightly. Now, their unemployment rate has changed notably from about 5% to about 7%. If you look at their unemployment rate, this is a very concerning rise to 14.6%. Now, this is even higher than the dot-com recession of 2000, and it's higher than, or almost as high as, the 2008 GFC. Youth unemployment rate is generally not good for the political class. Here is the 3-month rate of change for their jobs created, their version of the non-farm payrolls. And what we can see is that for the past 6, 7, 8 months, they've had multiple negative readings where jobs were disappearing. The jobs market was shrinking. And this is a 3-month rate of change, a quarterly rate of change. Right now, their job creation is running at 0%. So literally zero jobs being added to the economy. Now, here's the current account relative to the budget. These are the two main accounts to familiarize yourself with any nation's economy. Here we can see again the budget deficit. They're running about 2% budget deficit. Ever since 2008, a lot of things changed in the U.S., but also Canada as well. They went from running a budget and current account surplus, very, very strong current account surplus of 6% of GDP here in 2001, to a twin deficit of a budget deficit of about 2% and a current account deficit that just blew out over the past quarter. Now, we'll look at that in a second, but I do want to note that during this period of strength where they ran to a twin surplus, they were able to decrease their debt to GDP because, again, what that means is they are spending less on imports, paying less to the rest of the world than they are earning from selling goods and services to the rest of the world. Current account is mainly comprised of balance of trade. We'll look at that in a second. But I did go through the current and capital accounts on a quarterly basis, not as familiar with Canadian reports and how they present and lay out the data, but a couple things did jump out. So here is remittances. And what we can see is that that change notably jumped from about between $2 to $5 billion. Here last quarter was only 1 billion, all the way up to $8 billion. So that was notable, and that ties in with some of the hot button issues being talked about right now in Canada that we won't go into here. Here, their national net savings also declined this past quarter from about 140 billion down to just 97 billion. And if we look at who was hit the hardest, it was households. You can see the most notable decline happened with households declining from about 105 billion on average to just 88 billion. And finally, the rate, that national savings rate, declined from 6%, about 6% or 5.5%, down to just 3.8%. So here's really, I think, where a lot of the signal is. So in white and red, we have exports on a monthly basis. And what you can see is that exports just fell off a cliff over the past 2 months. They went from 74 billion per month in exports, Canadian dollars, down to just 61 billion. Now, imports fell, but they did not fall nearly as much. So net exports, or the difference between the white and the red line, widened. Their trade deficit widened to a record here in, looks like April or May, a record of about 87 billion on an annual basis, 87 billion Canadian dollars on an annual basis. Now, it has recovered slightly, but is still running at 60 billion Canadian dollar deficit on a annual basis. Here is the calculation for GDP. NX is net exports. And so here are two other components. I couldn't find investment But we did find government spending and consumption, which are down here in this rate of change down here. Both of them are quarterly. We can see consumer spending is running at about 1.1%, pretty anemic on a nominal basis, and government spending is running at 1.2%. Again, this is a quarterly rate of change. So those are two of the offsets that could help to offset a widening of the trade deficit to that degree. Here is the yield curve for Canada, and the pink line here is showing you the spread between the 30 year yield and the 2-year yield. The kind of salmon color is the US 30 minus 2. The kind of gray line here is the Canadian central bank interest rate. And they started to cut much sooner in May of 2024. The Fed didn't start to cut until September, which they cut again there. And what you can see is they have been cutting much more aggressively than the US has, than the Fed has. And for example, they had already cut about 100 basis points when the Fed started to cut. Now, the other thing to note here is that the 30-year and the 10-year, as measured by the blue and the green line respectively, since they started to cut rates, both of those yields are up slightly. However, the belly of the curve and the short end are down in terms of rate. You've gotten a steepening, as you can see from the salmon colored line here. They have steepened. They went from an inverted curve here, max inversion of about 145 basis points at the max there, 150 basis points at the max there. The US, by comparison, their inversion was only about 117 basis point inversion. So again, during this period of time, during 2023, there was much more concern about the Canadian economy than there was about the US economy. 50 basis point spread, both curves were inverted, but 50 basis point more inverted for Canada indicates, a significant amount of extra concern for the Canadian economy. We can see here that their yield curve is only about 120 basis points, 30 minus 2, and the US right now is about 125. So the curves have normalized. They both uninverted here in kind of the summer of 2024. So here's the stock market on a nominal basis. And this is the return, the percentage return going back to the start of the chart. So since 1991, the Canadian stock index, their version of the S&P 500, is up 725%. And for comparison, the S&P 500 is up 2,000%, and the DAX, which is the German stock index, is up about 1,600%, 1,600%. Now, if we zoom in a bit to just 2025 onwards, just year to date, there will be something that is probably going to surprise you. So here we can see that the Canadian index has actually outperformed the S&P 500. These are all in native currency. So the DAX is in euros, this is in Canadian dollars, and S&P is in dollars, US dollars. And we can see that, again, due to that weakness in the dollar, the Canadian index has outperformed the S&P, despite the S&P setting new all-time highs and showing strength, is outperformed by about 8%, and the DAX as well by about 8% on that sort of basis. Now, I do also want to show a couple things here in terms of the financialization metric of stock indexes relative to the average hourly wage. So here we're looking at the average hourly wage, or the S&P 500 divided by the average hourly wage, going back to about 2010, relative to the Canadian stock index, measured the same way, which is the TSX divided by the Canadian average hourly wage. This gives you a good idea of kind of the financialization or the degree of financialization of an economy. Is the stock market appreciating much faster than the average hourly wage? Here in the US, the stock index here for the US S&P 500 has outpaced the average hourly wage since 2009 by about 240%. Now, if you look at Canada, it has only outpaced the Canadian stock market has only outpaced the Canadian average hourly wage by 71%. So still a good degree more of that financialization effect in the US economy. Another important thing, Canada is very resource rich and they depend on, here we're going to look at currencies. They are the fifth largest exporter when it comes to petroleum. That is a huge part of their economy is petroleum and petroleum related products. So here we're looking at the Canadian dollar versus the US dollar in white. And then we're looking at the oil price in dollars in blue. Their economy has shifted towards more of a service oriented economy over the past 10 years. So you have seen a bit of a break between this. This is generally known as a petro currency or commodity currency, which is where when a certain commodity dominates a country's economy, you can see a very, very high correlation. In fact, it's 75 to 93% positive correlation between the price of oil and the strength of the Canadian dollar. We have seen a weakening of the Canadian dollar, although I would point out that it looks like it's based here with this kind of triple bottom here. The Canadian dollar might start to outperform the US dollar if this base holds. And the reason for this is that when commodity prices rise, the export revenue for that country, for Canada, right, the revenues that are tied to oil increase. Well, as those revenues increase, that boosts economic growth. That also attracts foreign investment and it strengthens the Canadian dollar as those foreign capital must buy Canadian dollars to invest in local businesses or invest in their stock market or buy their bonds. On and on and on. So you see a strengthening of the Canadian dollar, and this is tied directly to the price of oil, boosting their export revenues. Now, here is GDP per sector. This is on a real basis, so an inflation adjusted basis. We can see agriculture and utilities are basically nothing. Transport, mining, public administration, construction, and manufacturing. Now, in Canada, manufacturing still makes up a healthy amount of their GDP. Construction does as well. Now, I'm going to add a couple more in here. Government spending, we can see just dwarfs all these other sectors, about half a billion Canadian dollars per year, and then services. So I'm not really sure. I tried to get to the bottom of if this is just a glitch or data. They changed the methodology for measuring services. I could not get a straight answer, but services is a major component of the Canadian economy. Here we can see that services represent about 70% of GDP. Now, I did fact check all of these metrics. So they are correct in terms of share of GDP. Services make up about 70%. Government spending makes up about 23%. But once you include all government spending, like transfer payments, benefits, that sort of thing, it's actually 42%. This is significantly higher than the US. And we can see a dramatic rise in government spending as a share of GDP. In 2019, it only made up about 19% of GDP, and now it is up to 23%. Construction makes up about 7%, public administration about 7%, manufacturing 8%, although I will point out it was as high in their kind of current account surplus and a twin surplus boom of the late 90s, early 2000s. Construction as a share of GDP back then was about double, about 15% of GDP. And those are the sectors as a share of GDP. So dominated by services and kind of that government spending. So, of course, growth. Here we're going to look at GDP growth, growth rate per year. And remember, GDP is just the total economic output of a country's economy. Here we're looking at an annualized rate based on quarterly data. And then in white is kind of the annual, more smoothed sort of data. But why I wanted to include the yellow line, the quarterly annualized out, is as of that last quarter where their current account blew out, where their trade deficit blew out, their economy is running at this rate of 1.6% contraction. Now, you can see that that is very rare outside of a recession, such as the long-term capital management 1990 recession and the 2008 GFC, and of course 2020. If this holds, 1.6% contraction of their economy is quite significant. So here is the month over month Month over month, their GDP fell by 0.1% on a monthly basis for the last print. Their inflation rate is running at a very moderate 1.9%. Now, unlike the UK, which has very much of a stagflationary vibe where you have inflation running at like 3.6, I think it was, and GDP curling over. Now, in Canada, you do have that real growth starting to curl over and actually go negative, but at least inflation is a relatively healthy 1.9%. So that is positive. Here, if we're looking at nominal GDP right now, their nominal GDP is running at about 3.1%. So if we go back to the yield curve here, you can see that that is well above their nominal growth rate is well above the short end and the belly of their yield curve, meaning as long as they issue in that kind of short to medium part of the curve, their nominal growth rate is above their the cost of the debt or the interest rate on the debt. And then finally down here, we're going to look at wage growth. Wage growth is running at about 3.7% on a nominal basis year over year. Now, here I think is really where the story with growth really kind of is shown. So here we're looking at two things: GDP per capita. This adjusts for population change, and what we can see, that's the white line here. I did my best to kind of get a best fit line for GDP per capita going back to the 80s, and what it looks like is that on average per person, they are missing out, very similar to the US and the UK and France. There is this kind of flattening out of GDP per capita all around the developed world. For Canada, that translates to about 6,000 Canadian dollars per person. Now, one of the reasons that GDP per capita is basically shrinking, GDP per person is going down at a 1.4% annual rate, is because their population dramatically increased. So again, the red line hopefully is much easier to see that that is a very, very tight fit to their population on a logarithmic basis. So this adjusts for exponentials. Despite that, despite it being on a logarithmic scale and the best fit, the trend line, we can see that looks like they should have, according to that trend rate, they should have about 39 million people, but they have 41 million people. So that is about 2 million extra people above the trend rate of population growth. And again, this is a logarithmic scale, so it adjusts for exponentials. So the fact that you see an exponential rise on a logarithmic scale really kind of drives home the degree to which this is really increased. Kind of far above the norm. And here, the red line shows the annual rate of change of population growth. You can see that at the peak here in 2023, their population was growing at 3.7% on a year over year basis. I found this on the Canadian government data website. This shows the quarterly growth in population. And again, just this one quarter, the third quarter of 2023, their population was growing at over 1% in a single 3 month period. So, again, if you grow your population far above kind of what it should be, your GDP per capita, which is per person, you are growing the denominator rapidly, much faster than you're growing the numerator, which is GDP. Therefore, you are going to get negative GDP per capita. Hopefully that makes sense. Here's a look at their central bank and kind of some of those dynamics. We can see debt to GDP is 110%, so not nearly as much as the US at about 123%. Their central bank balance sheet as a share of GDP went from an average of about 4 to 5% all the way up to 18%. Now, this is lower on an absolute basis than the US, but still quite high. M2, we can see, has the money supply has grown much faster than GDP. We can see that reflected with this green line. We can see M2 as a share of GDP went from about 55% all the way up to 170%. Now I'm going to show FX reserves. These, by the way, are the FX reserves of Canada. So you can see that there. Those are running at about 174 billion. I think this is Canadian dollars. And then finally, gold reserves. They, much like the UK and France and most Western developed governments, did sell a significant amount of gold. Their gold shares declined from about 32 tons all the way down to zero. And why this matters, or something that it triggered, was here's the tick data for the major foreign holders of US Treasuries. Here's Canada. So here's March. They held 426 billion US dollars worth of US Treasuries. They are our fifth largest holder of our government debt here from the US. This declined significantly. So we did a bunch of videos that actually kind of went a little viral back in April during the chaos of Liberation Day. And we pointed to Canada as one of the prime sellers of US Treasuries. You can find that if you go all the way back, who was dumping US Treasuries. Well, the tick data shows that they were dumping a significant amount of US Treasuries. They declined from 426 billion down to 370 billion. So they sold about $50 billion of US Treasuries just month to month. So that is a significant decline there. And they still hold about $500 billion worth of US Treasuries. Now, of course, I want to look at wages. So here is the nominal wage for the average Canadian. This is per hour. You're earning about 31.6 Canadian dollars per hour. But of course, we need to look at it in real terms. So here's wages as a share of gold. And I multiplied this by the dollar amount. So you can see that Canadian wages in gold terms are similar to the US, reaching a all-time low. And of course, also total wages as a share of the money supply, much like the US. This has declined from about 126% total wages, again, using the average hourly wage, the civilian labor force multiplied by the population, and you can find the total wages earned in the Canadian economy, find that as a share of the M2 money supply. This used to be 126%. It is down to just 57%. So, put another way, the money supply has been growing much faster than wages. So, that silent depression concept is at play in Canada as well. So, of course, home price affordability. This is one of the major issues for Canada. Here in white is the home price index. It declined, or excuse me, it increased significantly during the past couple of years, much like the US, about 21%. Now, here is the home price divided by total wages. You can really see that affordability story there. Here is, however, the home price divided by the M2 money supply. So, on a real inflation adjusted basis, much like in the US, homes are actually getting cheaper on a real inflation adjusted basis in gold terms and in M2 money supply terms. Uh, Housing and single family homes are really not a good way to protect against debasement. Now, they're levered, so you do get some kind of price appreciation or wealth creation because of the leverage. But in general, the M2 money supply is growing faster than home prices. And of course, we can see that gold is rising at a faster rate. Again, I multiplied this by the exchange rate to get it in Canadian dollar terms. We can see that the blue line is even lower. It is an all-time low, whereas in the US, it is near an all-time low. But Canadian home prices in real terms, in gold terms, gold is a much better way to store wealth, it appears. Again, you have to factor in the leverage with the home price. Now, at the peak, home prices were rising 12% per year, and that continued for about a year. So, home affordability is certainly a crisis. Now, the last thing when we get to, we'll mention the U.S. Treasury selling at the very end here, but I did want to throw in a positive shout out. So, as I was going through doing research for the video, I found in their kind of statistics, their government data website, I found this thing that was the Quality of Life Hub. And they describe kind of the ways that they look at quality of life, these different factors. Some of them are kind of silly, but I think this is a great step forward. Would love to see the US do something like this. They are not using, they still calculate GDP, but they are starting to include much more meaningful KPIs or key performance indicators for their people. Life satisfaction. How many people reported having a high satisfaction with life? And they're tracking it like they would any other economic data. Sense of meaning and purpose. I mean, the outlook for the future. This is the right way to do it. This is I got to give props where props are due. Canada is kind of not exactly the best on everything, but this is man, this is crushing it. This is hitting it out of the park. I would love to see the U.S. at least try to look at to measure life expectancy. Look at the birth rate. Look at some of these. Your perceived mental health of your people, physical activity. How active are your people, right? And this is just the healthcare section. You can go through society. They are tracking these. Now they say it's a work in progress, but they are tracking some of these metrics as KPIs for their people. How many people have someone they can count on? The sense of belonging to your local community, your trust in others. I did see like government trust in government officials, right, and government institutions. All of these sorts of things. The fact that they are at least trying to track this data is a great thing, in my opinion. So, are they going to sell U.S. Treasuries? To answer that question from the intro. So, when you have a current account a deficit and a fiscal deficit, you are running a twin deficit. What that means is that you must constantly raise money. You must be constantly attracting foreign capital just to finance kind of, social security or medical payments, right? They have a national health service. The key services of a government. You are forced to raise money from the rest of the world, and so that is what a twin deficit is. You are accumulating debt, and that debt is being held or accumulated or added to by foreigners. That foreign capital is what is keeping your economy, your people, your society, your government alive. Well, a twin deficit nation is the worst possible debt holder for, if you're the US. You do not want a twin deficit nation to be holding your debt. Now, Japan, it is slightly out of frame here. Japan is exactly the opposite, and China to some degree. They run a twin surplus, right? So, very large current account surplus at the very least, and so they are less prone to selling your debt. They are major creditors. They are not going to get into a spot where they are forced to sell your debt, again pushing our US yields higher. They are not going to get into that sort of position because they don't run a twin deficit. On a net basis, their countries are net productive and they are accumulating net national savings. That's who you want to hold your debt, not twin deficit countries like the UK, which has risen to the second largest debt holder for the US, and Canada, which is the fifth largest debt holder for the US. These are both twin deficit nations. Now, if Canada could return to the current account and fiscal surpluses that they ran back here, this would be, that would make Canada a good debt holder. But the fact that they are running a pretty large twin deficit means they could be forced to sell US Treasuries. And especially if their current account starts to blow out to this degree, you mix that with a weakening labor market, as we saw here, their unemployment rate, especially their youth unemployment rate, which is quite high, and shrinking jobs. You add that in with kind of anemic consumer spending and government spending. Now, they can always run an even larger fiscal deficit, which is probably what they'll do to offset the net exports falling off a cliff. But they are under significant pressure here from the US, ironically. It is the US tariffs that are doing this. And ironically, it is the US tariffs that are plunging them into a current twin deficit, an even larger twin deficit. And it is the US tariffs that might force Canada to sell their US Treasuries, their foreign exchange reserves, to raise money to, again, cover the twin deficit, to finance the critical infrastructure and government and societal spending that, just to keep the wheels on the bus for Canada. So there's a bit of irony there. You put the pressure on. It is clearly, the tariffs are clearly hitting Canada quite hard. But the ironic thing here is it could force Canada to sell a good $438 billion of US Treasuries. They have a lot of U.S. Treasuries that they could sell to raise money to keep the wheels on the bus. So that's kind of the supreme irony here with the tariff. So, anyways, hopefully that video was helpful. I know like 10% of the subs are from Canada, so hopefully you enjoyed that, and I will catch you in the next one.